Well, hello there. I'm Gemini.
All right, welcome to The Explainer. Today, we are diving deep into the true cost of raising money for a business. We're going to break down all the hidden tax implications that can completely change the numbers on you. This is all about what happens between that initial handshake and the final tax bill. So let me ask you this. What's the real cost of raising $100,000? You might think, oh, it's just the interest rate on the loan, right? Well, that's not even half the story. The truth is way more complex, and figuring out why is absolutely essential for making any big financial move.
Okay, so here's our game plan. First, we'll look beyond the obvious costs. Then, we'll get into the nitty-gritty of what it actually costs to issue securities. After that, we'll tackle the really fascinating stuff, discounts and premiums. We'll run through a detailed case study to see it in action. And finally, we'll look at the whole picture from both the company's and the investor's perspective.
So, right off the bat, let's get one thing straight. That big headline interest rate or the dividend you see advertised, that's just the tip of the iceberg. It's what gets your attention, but the real costs are lurking just below the surface.
See, the actual calculation has to include a whole bunch of other things. We're talking about legal fees to get the paperwork done, commissions for the people selling the bonds, and even how the market can shift the price before you've sold a single one. These are the things that really determine the bottom line.
All right, let's tackle the first big hurdle, all the direct costs a company has to pay just to get its stocks or bonds out there. And this isn't some abstract concept. We're talking about real money going out the door before you even see a dime from investors.
And look at all this stuff. You've got legal fees, printing costs, commissions, the list goes on and on. Now, here's the key. The tax authorities look at all these expenses as capital in nature. Why? Because they figure the benefit lasts for the entire life of the security. But just because the benefit is long-term doesn't mean you get the tax break right away. And here's the catch. You pay all of this money up front in year one. But the tax man says, whoa, hold on. You can't deduct all of that at once. You're forced to spread that deduction out, taking only 1/5 of the cost each year for 5 years. This little timing difference can have a huge impact on your cash flow and what this financing really costs you.
Okay, now we get to where the market itself starts to play a role, and this is where it gets really interesting. Why would a bond that literally says $100 on it end up selling for $98 or maybe even $102? It all boils down to timing and interest rates.
Let me paint you a picture. Imagine you're creating a bond, and you set the interest rate at 7%. Sounds good, but, stuff happens, time passes. By the time you're actually ready to sell it, new bonds hitting the market are paying 7.5%. Well, who in their right mind is going to buy your 7% bond? Nobody. So what do? You have to sell it for less than face value, say for $98, to make it a fair deal. That's a discount.
And this right here, this is a huge distinction you have to understand. If we're talking about equity, like company shares, offering a discount has basically zero impact on the company's taxes. But for debt, like bonds, oh man, it changes the entire game. Because the interest on that debt is tax deductible, suddenly how the government treats that discount becomes incredibly important.
So, let's get our hands dirty and walk through a proper case study. We're going to follow a company issuing a $100,000 bond. You're going to see how one seemingly small choice about the interest rate sends these massive ripples through the final cost.
Now, before we even look at a single number, you have to burn this rule into your brain. The tax code literally splits discounts into two kinds, shallow and deep. Stay in shallow territory, 3% or less, and you can deduct the whole discount. But if you cross that line, even by a tiny bit, you fall into a deep discount, and that's where the hammer drops. You can only deduct half of it. It's a massive penalty.
So here's the scenario. Let's say the going market rate is 9.25%. If our company offers that rate, perfect. The bond sells for the full $100,000. But what if they try to offer a lower rate, like 9%? Well, to make it fair for investors, they have to sell it at a discount for $98,000. That's a 2% shallow discount, no problem. But if they push their luck and go down to 8.50%, they now have to offer a $5,000 discount. And bam, that's a 5% deep discount.
Okay, now if you only look at the costs each year, you'd be totally fooled. I mean, check out that 8.5% bond. It's got the lowest after-tax cost by a mile. It looks like an amazing deal because you're paying less cash and interest every single year. But, and this is a huge but, this view is dangerously incomplete. And here's the gotcha moment. At the end of the 10 years, the music stops. The company has to pay back the full $100,000, even though they only got $95,000 in cash. That $5,000 discount just became a real out-of-pocket cost. And because it was a deep discount, look at the tax saving. It's tiny. The net cost of that discount is enormous.
And this chart, this is the punchline. This tells the whole story. When you factor in every dollar and every tax roll over the entire 10 years, that boring bond sold at face value was the cheapest option all along. The shallow discount was a bit more expensive, and that deep discount, the one that looked so good year to year, was the most expensive deal of all for the company.
All right, so we've seen how discounts can be a trap. But what happens if we flip the script completely? What if you set your bond's interest rate and then market rates actually go down? Well, now you get to issue it at a premium. And the tax rules for this are, let's just say, extremely nice.
This right here, this is the golden rule. Let's say your bond pays 10%, but the market now only expects 9.5%. You can sell your $100,000 bond for maybe $103,000. That extra $3,000 you just got, for most companies, it's not taxable. Let me say that again. It is a tax-free gain. That is a massive, massive advantage.
So just think about how this plays out. You get this big chunk of tax-free cash right at the beginning. Now, yeah, you do have to pay a slightly higher interest payment each year, but guess what? Those payments are fully tax deductible. So that tax-free boost you got up front more than makes up for it, bringing your total after-tax cost way down. It's the polar opposite of the discount nightmare. So this all brings us to a really logical question. If issuing bonds at a discount is so much more expensive for the company, why on earth would anyone ever do it? And the answer is pretty fascinating. You have to stop looking at it from the company's side and look at it from the investor's side of the table. And this is where it all clicks. See, what is a financing cost for the company is a potential gain for the investor. When that investor buys a bond for $95,000 and gets paid back the full $100,000 at the end, that $5,000 difference is their profit. And here's the real kicker. That profit is often treated as a capital gain, which is usually taxed at a much, much lower rate than regular interest income. So you see, this isn't a rookie mistake. It's a strategy. A company might actually choose to take on a higher financing cost because offering that discount makes their bond irresistible to certain investors. It's a trade-off. You're balancing your own costs against what it takes to get the deal done in the market.
So after all of this, the 5-year deductions, the deep discount penalties, the tax-free premiums, it kind of makes you realize that the stated interest rate is never really the full story, is it? The real, true cost of raising money is always hidden in the after-tax details.